Hi everyone, this is Cliff Steele. It is Friday, March 10th. We wanted to put out a video today giving a quick update on a few things. Today's video is going to go over how we saw the calendar year of 2022 close out on the markets, with inflation and interest rate data driving a lot of movement there. The start of 2023, what we have seen so far up to March 10th, it's been lots of movement, both up and down, so going over that. We're going to talk about inflation, interest rates. We're also going to get into a little bit of the headlines that we have seen around a particular Silicone Valley Bank. We'll get into some details on that because we might have some clients that have some questions on what's going on there. We also want to go into a little bit about recovery and continued recovery we have seen since the bottom of the market. So we're going to get into all that good information. And I'm going to pass it over to Mario to take it from there.
Now, before we get into the current markets, just want to do a quick flashback to this past year, as we did see a tremendous amount of volatility and we did see a larger market correction. This correction was mostly driven by worries of inflation and government efforts to fight inflation. There were other events such as the Ukraine war and supply chain issues that also took place last year, but the core of the focus the markets have had has been on inflation and the efforts to gain control over inflation. Now, we do want to touch on what happens typically after a market correction. As you can see here, these are all the market corrections throughout history. Throughout various periods, some of these corrections have been above negative 10%. So we have highlighted them on this chart. You can see that the correction last year did end in October. And some of these corrections can be quite large in size, but they do have a commonality that they tend to last anywhere from 6 to 12 months. And typically, we tend to see 3 positive years every 4 years. And it is normal to see a correction. And what we do see after a correction that's worse than 20% is the following event: a typical 9.7 per year return for the preceding 5 years. So that's typically the value of staying invested. Some people do discuss the idea of market timing, but the majority of the return, or some of the largest returns, tend to happen right after that correction. And if we look at right after October till December, the markets were up almost 8%. So this is why we do tend to preach about the idea of staying to your investment portfolio and your risk tolerance and writing out these corrections. As we enter this current environment in the markets and we look at today, we are nearing the end of this inflation cycle. In some cases, such as the Canadian government and the Canadian Federal Reserve, you're seeing them halt their interest rate increasing program as they do feel inflation has normalized and we're getting down to a more normal pace. In the case of the US Fed, they went from a 1% increase to 0.75 to 0.5, and now discussions of ending their program by this summer or the fall as inflation is also moderating in the US. As we've seen historically, when we look at past inflation cycles, as inflation does tend to decrease down, the markets have more comfort on pricing and they tend to find their footing. Now, as a quick update on inflation, as you can see on this visual here, you see that inflation at its peak was over 9%, but as it's continued to progress down lower and lower month by month. In some months when inflation does drop by more than expected, the markets tend to bounce up quite a bit. If inflation does move a little bit slower than expected, the markets tend to pull back a bit, but we continue to have this seesaw movement of inflation slowly tapering down, the markets going up and down, but in a positive fashion over time. So as we look through historical inflation and how it has acted with the markets, we do tend to see this orange line, which is an indicator for inflation, and the blue line as an indicator for the markets, a certain correlation that exists. As inflation continues to grow unchecked, the markets tend to proceed to go downward in a negative spiral. And as inflation comes under control, the markets find stability and price confirmation of where we are for interest rates and tends to recover. As we look at throughout the 60s, 70s, and 80s, it's a trend that tends to repeat itself. And as we've seen recently, when inflation coming down, the market's going up, it does seem to be a trend that will likely be repeating over the next 12 to 24 months. Now this segues into the idea of active management versus passive management. As we look at the difference between investment management styles, there is an approach which is passive, which is buying an ETF or an index, which will buy everything in the broad market. And some of the reasons people like these ETF or index options is that they're very low cost and they give them broad diversification and you get to copy whatever the market is doing. And it involves very little thinking. There's no actual thought process to it. You just own the index, and whether it's good or bad, that's what you receive. At the Steele Group, we are stronger believers in active management. There is more cost and investment put into doing research, analytics, different styles and approaches are taken. And the idea is that you don't want to just receive what the market gives you. You want to try to pick the best performers while avoiding some of the worst performers. And when times are running really well and everything's working correctly, active and passive can look very similar. However, in times of great volatility, whether negative or positive, active management gives you the opportunity to achieve higher rates of return or even better risk-adjusted rates of return if you're more conservative. So we're going to look at a couple of companies this year that we've seen how active management can play quite a bit of value. And so if investors in our funds are a little bit more growth oriented, and they tend to be driven to more, let's say, a US equity position, such as the Global Innovators or some of the US equity funds, they may have a position called NVIDIA, which is a chip maker. And as you can see in this chart, they've had a tremendous year. An active manager can choose to not just buy the regular allocation to NVIDIA, but they can overweight it or increase a slightly higher position. So overall, the portfolio can achieve a higher return than its peer group. Now, if you are looking at a passive investment, which will own every security, they will also own NVIDIA, but they'll also own companies such as Silicone Valley Bank. Silicone Valley Bank's been in the news recently, as they are the first bank since 2008 to go through a bankruptcy procedure. They're not a large bank such as Lehman Brothers or what we saw in 2008, but instead more of a regional bank. They focus on venture capital within the Silicon Valley area. They do a lot of large transactions, but highly concentrated to some of these tech startups. So unfortunately for some of these businesses, they're having a hard time getting a hold of the deposits until this whole clearance process is settled. Eventually, there'll be a buyer for some of the assets, but if you own the S&P 500 ETF index, they'll own a position in this portfolio. Some of the biggest holders of this stock, if you're to pull up the stock and look at some of the biggest investors, they're mostly index funds. In some cases, a large ETF, which is copying the S&P 500, all the indexes combined, held anywhere from 2 to 3% of their position on here. And if you look at some of our portfolios, and we actually went through the activity of looking at some of our most conservative portfolios to our most aggressive portfolios, none of our investment funds that we had selected for our clients own this particular investment. And that's truly the value of active investing. A lot of institutional investors, a lot of active managers looked at this company and saw that they were having some funding issues with their bonds and were having some struggles, and they made the active decision maybe to own more NVIDIA and own less of this. And while a passive investment option would own a little bit of everything. Now, where this is very important is if we look at a period of the tech bubble. And that was back in the year 2000. And it's also referred to as a lost decade. As you can see from the year 2000 to pretty much 2008, 2010, you could have invested, lost all your money, seen a full recovery to only see it go down again. For ETF investors, index investors, they would have seen very little growth. It would have been very disheartening. But for management teams at EdgePoint, or if you look at Maurer Balanced, and if you had to grab their performance throughout this time period, they provided tremendous rates of returns throughout that period. Because throughout this entire time period, there are great companies making great earnings, great revenue, just like NVIDIA today is doing fantastic for their shareholders. The active managers were able to select companies like that and do very, very well. And so typically in this next 12 to 24 months, as we expect continued volatility, as we continue to adjust to the new inflation and interest rate normal situation, these active managers are really taking advantage and providing a lot of good downside protection last year and also providing a lot more upside growth so far this year. Now I'll pass it off to Cliff for a few words.
Thank you very much, Mario, for going over all that information with respect to inflation and direction we think the market's going in, and touching on the headline news we see today about the Silicon Valley Bank. I did want to take a little bit of time just to dive a little bit deeper into that, because it's going to be dominating the headlines and probably a lot of your news feeds and things. You're going to see information about this, and we just wanted to talk a little bit more about it. So as Mario mentioned, SVB, or Silicon Valley Bank, is a very regional bank. It is not even in the top 10 largest American banks. Unlike Canada, where we have very few very large banks, the US has few very large banks, but they also have many smaller banks. So SVB would be on the smaller end, especially when you're comparing it to other American banks. And one thing that we wanted to go into a little deeper is just how this is kind of rippling into other areas of the market. Mario mentioned about active management, and this is definitely more of a worry for our more growth-oriented clients. Our more conservative clients, our more balanced clients, this is not going to have the kind of impact on your portfolio. But because of the active managers that our office uses for our growth clients, we're not even really seeing a lot of fallout in those portfolios. So I wanted to talk a little bit more about that today. So first thing I want to jump into, and Mario already reviewed that a little bit, is SVB, or Silicon Valley Bank shares. We can see year to date, that is down 53.92%. Really up there. Depending on the system you look at, if you have some of the future forecasts on it, it might even be down 60% year to date if you're looking at it. But this chart shows it down 53.9% for 2023. If we go and look at one of the very common holdings of our practice for our growth clients is the Fidelity Global Growth. If you've had a meeting with us recently, you've probably heard us say that name many times. This portfolio, as Mario mentioned, has no SVB shares in it. And you can see that on a year-to-date basis, it is still up 5.17%. We're seeing a little bit of a movement here, but nothing crazy. We're pretty well at the same value we're at mid-February. So not a bad thing at all. It is going to feel it a little bit, but it's not directly exposed to it. Even our more aggressive clients that have pure equity exposure to that tech sector, so you think this one would be really feeling it, it's down a little bit, similar to the Fidelity Global Growth. This is the MFS US Growth. As you can see year to date, it's still at 5.2. And again, this has no exposure to SVB in it either, as none of the investments that we recommend does. So this is really what we wanted to highlight today, that if you're a growth client with our office, more exposed to equity investments, you have no direct exposure to SVB. Another headline that I have seen today that I thought would be good to talk about is because SVB is obviously a bank, Silicon Valley Bank, spreading into other areas of the financial system. Really more of a headline thing. Banks aren't terribly interwound in that way. You could look at JP Morgan shares as an example. They're actually up today on expectation that they'll be able to pick up some of the venture capitalist business that SVB used to take care of. So not all banks are down, but generally speaking with our office, we have always been rather, not negative, but we haven't really been a big promoter of buying into banks, Canadian or American, especially Canadian. So today we're seeing a lot of sell-offs in the last few days of RBC, Scotiabank, TD. Again, that doesn't really impact our client portfolio because we've never had a very large exposure to Canada. Again, talking with myself, Mark, or Mario, we're always very light on Canada for as far as exposure goes, so that's also helping as well. But with all this information, just wanted to reiterate that the SVB situation is, we're aware of it, we're monitoring it, and we're very happy to report that it has no direct exposure inside any of our clients' accounts. If you wish to contact our office to talk further about how what's going on may impact your portfolio, please feel free to reach out to any of the advisors here at the office. We're always happy to chat.